and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we are pleased to welcome Brandon Cotie. How you doing today, Brandon?
Good, Alex. Thanks for having me on the show.
Yeah, absolutely. So we've taken a lot of different approaches to looking at investing in multifamily real estate and commercial real estate, and typically on this show we've kind of uh, looked at it from people that are kind of getting it. They get the bug to do it. They do a limited partner, kind of come in to be a passive investor. Then they get the itch and they're like, all right, I want to do general partner stuff. I want to put together, I want to syndicate my own deals. Or we've talked to people that are large syndicators that kind of have been plugged in and have been rolling with this and talking about the aspects of doing these kind of things. But we haven't really taken the approach of someone who is very comfortable and very successful in the limited partner space. It's not every single person wants to, immediately transition out and do it. Some people are mainly just interested in saying, hey, I like the aspects of passive income, not having to deal with tenants and toilets. And when you're talking about commercial real estate, that's a whole lot of tenants and toilets. So being in that passive position and how to make that work effectively, and not to say that, there might be, some interest in yourself, you, Brandon, or anyone else, getting into it and wanting to get a bigger piece of the pie and do syndications from the general partner perspective, but we really haven't kind of had a good focused discussion on being a limited partner, what it looks like to do that, how to identify the deals, how to navigate it to be successful, and what that's meant for you. So again, thanks for being on, and I'm really looking forward to talking about this. So give us a little bit of background on yourself. One of the common threads with anyone in commercial real estate is that this isn't something that you just plug into right out of college. You don't get a degree in being a commercial real estate investor. So, give us a little bit of background on yourself and, kind of how you got to the position here, and then we'll kind of roadmap it from there.
So I got into mortgage lending back in 2005, and I still do that to this day. So I get that kind of ties, goes hand in hand with real estate. So it was probably back in maybe 2017. I did my first fix and flip hands-on. And then, I did a couple other flips from there, more as a passive investor. And then I started listening to more and more podcasts, just absorbing as much content that I could, and started learning about using the self-directed IRA. So I looked more and more into that, started looking into the possibilities, what you can do with the self-directed IRA. And I had some money from a rollover sitting in an IRA from a previous employer that just wasn't really doing much for me. So, I decided at some point, I said, well, I want to do something with this, deploy those funds. And that's kind of when I started, segueing into the multifamily space using self-directed IRA funds.
Awesome. Great. So, you did your research on it, and I'm assuming, was it kind of one of those things where, you initially got into fix and flips? Obviously, you saw the value in real estate being in the mortgage side of things, saw people being, how to make money doing that. And then, getting into a fix and flip, I'm assuming that you probably had a similar, kind of experience with a lot of people of saying, hey, this is a lot of work for X return. And then looking at saying, okay, well, how do I ramp this up? And looking at, the throughputs. I think the logical next step is saying, instead of saying, hey, let me go out and buy, 50 or 100, single family flips, let's look at something that has all of those stores in one package and, kind of gravitating towards multifamily. Was that kind of a similar trajectory for you, or did you have a kind of a different path in that regard?
No, I would agree with that. I mean, the fix and flips obviously can be very lucrative. Plenty of people have done them and still do them to this day and make a lot of money. But as I learned, it is a lot of hands-on. There's a lot of work that goes into it, some headaches and so forth. So just listening to more and more, people out there in the multifamily space, but also from a passive standpoint, as long as the deals make sense, it's pretty easy to either write a check or you wire your money, and then you just kind of sit back and you get your monthly updates, you get your distributions, and then you wait until the deal goes full cycle. So and then that allows you to do other stuff while you're essentially making money, sitting on your couch or sitting in your office. So
Absolutely. So let's look at that first deal that you were involved in. Obviously, we'll keep this 30,000 foot view. No need to actually say like the name of the actual investment, but when you kind of, how did you actually kind of find it? Was it something that, a friend of your, someone that you had a friend or someone that you met through networking doing this? How did that kind of first deal come to be? Because, you're not typically just, driving around your neighborhood and seeing a 100-unit apartment complex saying, oh, that'd be a good fix and flip. So how did that kind of come across your desk? And then talk us through the process of kind of, you as a new person to real estate syndication, what were maybe some of the resources that you used to help you feel comfortable doing it? What were some of the research aspects that you took in doing that? So let's kind of start from the beginning of, okay, you got this first multifamily prospectus, PPM that comes across your desk. What's that look like to you?
Yeah, that's a good question. So I had reconnected back in, I guess it was end of 2018, maybe early 2019, with an old friend that I'd played travel baseball against, and then we played on a team together. And he does syndication. So we reconnected, grabbed some coffee. He kind of gave me a run through on what he had going on, what he was doing. And he was basically raising capital and putting deals together. And so at that time, I had listened to as many podcasts as I could to absorb as much information as possible. And I was starting to kind of understand the metrics behind the deals, what they entailed, coming in as an LP, as a passive investor. And at that time, I felt comfortable. Well, it's two things. I felt comfortable with investing in that sort of deal, right? And then number two, the person I'm investing with, I 110% completely trust. And that's a huge component. So after that meeting, I think it was maybe not even a month later, he had a deal that rolled out. And, I read through the investment summaries, a lot of information. And having done it for the first time, I wanted to make sure I read it and reread it and understood everything that I was doing. And at some point, you just got to jump into it. You got to get off the sidelines and do a deal. So it was probably, I think, April of 2019, I got into my first deal. I had researched, using a self-directed IRA, setting it up. I set up my account with Advanta, and that's kind of where the story began, where the journey began. I deployed that money into that deal, and the rest is kind of history from there.
Yeah, awesome. So that's very, very much a common thread in a lot of people I've talked to, whether it's been, people on the, national stage of, doing multifamily investing, people like Rod Cleef or Vinny Chopra or, Wheelbarrow Profits with Jake and Gino, all of them kind of, as far as, the big top people always say, you have to be comfortable and understand whom you're investing in. And that's always great. And I think that's kind of a big thing to plug in and say, okay, that's, kind of no brainer. But from the paperwork side of things, you obviously had to do a lot of research because it's easy for you to have, a friend or someone that you had trusted, obviously you had that connection in baseball and the like, but when it came down to it, this is your money that you're giving someone. So, you can trust that person all day, but numbers talk, paperwork is paperwork. So what were some things that, you had, maybe research going into reading that first PPM or prospectus that, that you had, gone out and figured out, hey, here's what I need to look at, and maybe talk about maybe some resources that you had that helped you along reading that? Because, me as a finance professional and being involved in this, I can read through one of those things and make sense of it. But, if you were to have given me one at the very beginning of my career and just kind of said nothing, these things are typically like 120, 160 pages long. There's a lot of information in there to kind of digest. So what helped you in that initial, aspect of it, of saying, hey, here's this big packet of paperwork, let's talk about some resources that you use. And also, what helped you make sense of that?
That's a good question. I would say I'd probably draw back on my lending experience. Having gotten into business in '05, things were pretty good at that time. And then with the run up to the crash, right? And we saw, values just plummet, more on the single family side. And so all those years of seeing, all the cycles, values going up and down, but understanding that like single family home, like for example, a house I live in, my value is essentially based on what my neighbors are selling for, right? So when you go into a crash like we saw back in '08 or around that time, we saw values plummet. And, the more research I had done on multifamily, I just liked the fact that, the metrics were there. And one of the nice things are they seem to be pretty recession proof. So they kind of weather the storm, so to speak. And valuations in apartment building isn't necessarily the way a valuation would be on like my primary residence, for example. So if the market's down because my neighbor sold and they're down, apartment buildings might be a little bit different in the sense that they're evaluated a little bit different based on cash flow and so forth. So to answer your question, I'd say definitely drew on my mortgage lending, just all the years of seeing, values on a different end of it. Also helping out clients that bought, rental properties, seeing, those things cash flow. And I kind of took that, incorporated into what I had learned from a bunch of podcasts, and then just all the information and stuff, talking with my buddy who does the syndications, kind of compiled all that together. And, I felt really good, really comfortable about getting into that first deal. It was a little nervous, to be honest, but like I said, you just have to dive in and go with your gut. And I'm so thankful that I did it, because then one deal turns into two turns into four, and it just kind of snowballs from there.
Yeah, great. And I think you bring up a really good point in that on, looking at these deals, because it's easy enough to say, hey, my house is valued at X, neighbor sells for that. That's kind of what the value of it is. You're looking at it as more of kind of like, it as a whole package, not necessarily looking at really anything other than like, hey, here's what it sells for on the open market. That's not how deals with regard to multifamily are really looked at. It's mainly looked at, what are, the projected rents, what are the potential runoffs for being able to refinance and repay your investors. So it's kind of a complete paradigm shift from the look of, a single family home. And granted, yes, people do look at selling single family homes for or buying them on basis of cash flow. That's absolutely a segment of it. But I would say the overwhelming majority of it typically is not in the single family space. But the opposite is true for multifamily. So looking at understanding that that's kind of a difference in perspective of this investment, I think is important for people on the front end. So from, kind of coming from your perspective, what are some things that, are helpful if people are, looking at this to kind of understand about how that valuation model works when you're saying, okay, well, these people aren't just buying this apartment complex to turn around and flip it. What are some of the aspects that people need to understand about the generalities of coming in as a limited partner? Because again, it's a different animal. You're looking at things like cash flow, not necessarily the value of the property so much. It's more of a, value ratio of the income to the underlying debt, and also the value of the property. It's kind of like that. I'll let you expound on that a little bit, or as much as you'd like to, but I think that's an important part for people to, look at when doing this. So share some of your experience on that.
Okay. Yeah. I'd say kind of the general theme is, this is a long-term play. This isn't like, and again, I want to reiterate that there's nothing, absolutely nothing against fix and flips. Plenty of people have made a career out of it, made a ton of money. But, you can get in and out of certain deals at certain times of the market. Sometimes you win, sometimes you lose. With the multifamily, it's really, at least from my standpoint, the approach I'm taking is long-term. And you have to get into more than one deal, right? Because some of the deals, and I've had already a bunch of deals that have gone full cycle. Some of them, they do a cash out refi. As an investor, I get some of my money back, and then I can redeploy that into another deal. And then I'm still in that deal. Others have sold much quicker in a shorter time frame based on the market, and others are going to take longer, especially given the circumstances that we're seeing right now in the economy. I think the full cycle, it's going to take a little bit longer for these to sell. So you just kind of have to go into it knowing that this is a long-term approach. You're not just getting in and out of one deal. You're getting into as many deals as you can. And then you're kind of diversifying, so to speak, because you're going to have some deals that go full cycle in 15 to 20 months. Whereas though you might have other deals that might take 4 or 5, maybe 6 years to go full cycle. But when you kind of spread that out, I think it kind of spreads out the risk. And so I think that's the name of the game, is just to understand it's a long-term thing. You're not just trying to swing and hit a home run, get into one deal, make a bunch of money, get out, and then you're done. And then you're going to go invest in something else. You got to look at it as a long-term play.
Yeah, absolutely. And that's a good point to bring up, because, when you think about real estate, it's relatively liquid assets from the standpoint of something that is that big and tangible. It's, you can put if you own the single family home, you could probably sell it. Granted, today's market, you're going to wait a little bit longer. The past 2 years, it's, a few days on market till you have a contract. But, as far as large tangible assets go, relative liquidity. You can sell it pretty quickly, but that's not kind of the necessary play with that. It's always typically going to be a cash flow for a certain amount of years that you're looking at, and then prospectuses and PPMs will detail, when the expected either again cash out refi where they refinance, repay the investors, restructure the deal, or someone else comes in and buys the property and then all the investors get paid out. But in that interim is, cash flow. People talk about, the mailbox money. Not a big fan of kitsch terms, but it's what people use, saying, but, in that interim, it's not necessarily like you've invested and you have to wait, those 4 or 5 years to get money out. You're getting cash flow. What you're talking about in that specific use case is that, you getting your underlying principal back out. Where you're in that interim of that, you're making cash flow on your money, correct?
Correct. Yeah. And so the way I've kind of done it from the get-go is a lot of the deals I invest in, they might have a Class A and a Class B share. The Class A is going to go a little bit more upfront from a cash flow perspective, like month to month. And then a Class B share would be more, a lower preferred return, but you get to participate in a bigger piece of the pie, the upside in the back end when the property sells. So that's been kind of my mantra right now. I'm not living off of the cash flow. I got to get more and more deals going, but I like to participate in the back end when the properties sell, because then I just roll those into another deal through a 1031. And that's kind of cool because that's where you get the snowball effect. Now, going forward, will I kind of reallocate my strategy? I've already kind of thought about doing some Class A and some Class B. So some of my deals I'm getting a little bit more from the cash flow, right, month to month. And then some of them I'm not getting as much cash flow. But when the property sells, assuming it does well and it performs, I get a bigger piece of the pie, which is exciting too. And then I kind of have a nice mix of both spread out through all the deals, whether that's a 50-50 or a 30-70, that's something that I'm constantly kind of analyzing and looking into, and we'll see how that goes going forward.
Yeah. So when people are looking at this, and that's another good thing to bring up is kind of a very intro to this, is that when you look at deals, you'll have typically you'll have 2 to 3 different kind of places that you can plug in. There's the general partner, which is the more active position, which is, think about it kind of like the fund manager or the people that are actually running the show. And then you have your passive investors, which is your limited partners. And sometimes those limited partners can be classified as A or B investors. And then, that might all sound kind of like a little bit of, finance jargon, and it is to a point. But when you talk about that, of which part that you want to participate on, whether you want to be more cash flow heavy on your underlying principal, or if you want to participate more in the equitable upside in the sale of the property, and these can always change. I mean, people can write this how they want, but typically, again, generally, which one of those 2 types of class shares will apply to which one's more applied to cash flow, which one's more applied to the equitable back end on the sale.
So the Class A share would typically be the one that's more the cash flow. You can get a higher preferred return month to month. And then Class B would be, smaller preferred return month to month, but you get to participate in the profit on the back end. So, and that it depends. Everyone's got a different strategy. Everyone's at a different point in their life, depending on their age and maybe where your portfolio is. So, years down the road, I might start to move towards more cash flow, doing more deals from a Class A share standpoint rather than B. For now, I like the B. It's working well. But like I was saying earlier, given the current economic conditions, I think deals are going to take a little bit longer to go full cycle. Mm-hmm. So it might make more sense if you're in a deal instead of, for 15 to 20 months, you get spoiled and it sells pretty quick and you get a nice profit. Some of these deals you might be in for 3, 4, 5 years, and it'd be nice to get that bigger preferred return month to month. So again, it's what works for me might not work for the next person and the next person. So there's kind of not necessarily black and white. So, there's some gray area there. You got to figure that out on your own. And like I said, for now, I'm sticking with the B, but it's in my mix here to kind of start to filter in some maybe Class A deals too, just to kind of mix it up for myself.
Yeah, absolutely. And the really nice part about this, although these are, quote, alternative investments, which I don't really like the term alternative investment because it implies that this is something new or, exotic. I mean, people have been owning real estate, the entirety of human history. It's probably like you talk about things that people own or that are investments or value. It's, land is one of those things. So, um, and the point I'm trying to make with that is, when people look at traditional investments, again, don't like the term, but you talk about what are your goals? What point in life are you? Are you more, equity or value based? Are you looking more for cash flow? Which one is going to be potentially more stable? You can apply those same kind of metrics to this investment structure. You think about people think about bonds, day trading, all that kind of stuff. Those same kind of general principles can be applied to this asset class. And obviously I've worked in the alternative investment space for 10 and a half years. I've seen the inherent value of it. And like you talked about with things that are, you know, resistant to recession markers. People, when they lose their houses, they got to have somewhere to stay. They're going to rent. So, there is that kind of funnel effect of, people needing places to live. Not everyone is homeless, that does happen, but people need apartments to rent. They need shelter. And this offers that kind of intermediary aspect. And then also from the effect of inflation, you also get people getting priced out of buying homes. So they're forced to rent for longer. So you kind of have two nice pieces of the pie there. To say that you have these different investment structures that people are really used to that can be applied to this. So again, although it being an alternative, there are definitely some crossovers in the application of strategies for this, which I think is a really big benefit to people. And especially if you're getting into this, to understand that while you actually definitely do have to understand the economics of a new investment, it's not going to necessarily be something that is so overly new that it's impossible to get started in. I think that's very well illustrated kind of by your story of saying, hey, I was in this, I understand this, I've made it work. And the stuff isn't inherently rocket science. You need to do your research, but again, it's not too terribly crazy to understand that you buy it, you get cash flow, it sells, money comes in, money goes out. Not too hard to grasp that.
To kind of piggyback on what you're saying, I mean, I see it too from the mortgage lending standpoint. This has been a recurring theme here for a little bit now where there's just limited inventory of homes and condos out there, and people are continuing to have to rent, whether they're moving out of maybe they're living with family and then they can't find something, but they want to get out. They ended up renting an apartment, or maybe those people that were trying to buy a house, there's no inventory out there. They can't find anything, or they got outbid the last year or two. They extend their lease out another year or two at their apartment buildings. And so I've seen that. It's nice to draw off of that, just to kind of see and project where things are kind of going. Well, not necessarily where things are right now, but also where things are going forward. So,
yeah. So let's kind of, again, I love getting off on like the looking at these things. I enjoy those kind of conversations, but to kind of steer it back towards the people that are just getting into this from the perspective of someone that's done a lot of limited partner deals. We've kind of covered saying, hey, here's how I kind of got in my first one, here's what it looked like, it worked well. Now from the perspective of maybe let's say some of the things that you've done after that, what if things that you kind of learned along the way that have helped apply to the next deal to help you refine your investment strategy? Because obviously every single thing is not going to go 100% to plan. But so long as that general trajectory is going up, that's a good thing. So what are some of the things that you've learned or picked up along the way of investing as a passive investor in commercial multifamily that you think would be, kind of general nuggets of good information? And it can be something as simple as saying, yeah, continue to listen to podcasts, continue to network, continue to learn, because that'll help you stay abreast of the market. Or maybe there's some stuff, and again, nothing's too basic, because, if you don't understand the basics, you can't be, you can't expect to have success with the more complicated stuff.
Yeah, there's a couple things. I mean, yeah, podcasts, I know some people love them. Some people aren't big on them. I love podcasts. I listen to them all day long. I literally, whether I'm doing some work, I'm doing laundry, I'm working out, I'm always listening to a podcast. So I would say for anyone kind of getting into it, learn as much as you can, absorb as much information as you can, find some good ones. Usually they post once a week, and just absorb as much information as you can. So that's how I got into it. I still listen to real estate investing podcasts to this day, and I will continue going forward. That's one of the things I would definitely say. Networking is another one. The more people you talk to, I talk to people every single day about multifamily, whether it's people that are already invested in multifamily, people that are interested. Somehow it always seems to work into the conversation. So always talking to people, meeting more people. There's nothing wrong with that. And then just to kind of give like an actual example about, you asked about more investing after like the first deal. Not too long after I did that one, my wife, so her previous employer, she had a 401k sitting there, and had probably been a year or two, and wasn't making her any money. In fact, it was probably costing her money. And the administrator for her account reached out and said, "Hey, you have to do something with this." So she asked me, "What do you suggest, Brandon?" And I said, "Well, let's open you up a self-directed IRA. Let's roll the funds in there and let's get you into a deal." And timing worked out perfect. I think that was early 2020. She got into a deal and it went full cycle. I want to say it was about 20 months. And so that money that had been sitting in her account at her old employer's administrator, whatever the 401k was, not making her anything, she basically almost doubled her money in less than 2 years. And now that deal's rolled into another deal, and which is comprised of a couple different buildings. And so, we'll let that one roll. And when that sells, we'll roll into another one. So it's kind of like I always tell people, it's like a puzzle. It's you're putting the pieces of the puzzle together as you go, and it's fun. I love it. I love talking about it. I love doing it, and it's kind of like turned into a little game now. So
Awesome. So from that trajectory, let's take a look at this. So you've obviously been, had good success in deals. I'm assuming, and again, if I'm wrong, then you are one of the luckier people that I've ever met. But I'm assuming you probably haven't invested in every single deal that you've looked at. Whether it be for a multitude of different reasons, whether it's, just it wasn't, kind of the right market, did some things make you feel uncomfortable about it? If you have had some deals that have come across your desk that you haven't invested in, tell us maybe why you elected not to go with a certain deal. Was it red flag based? Was it just maybe not the right fit? What were some things that looked at that weren't a fit for you? Not to say they wouldn't be a right fit for someone, but it's always important to understand that, just because you're getting into multifamily and you might get exposed to deals, just like, looking at a stock ticker sheet, you should not buy every single one on that sheet, just like you should not invest in every single, apartment building that's out there. So maybe give us some guidance on maybe what you've seen that, hasn't worked for you, whether that's kind of a big red flag that everyone should run from, or just maybe some things that didn't work for your investment strategy.
yeah, that's good. There's probably a couple different things. I mean, I see deals all the time, and I'd say area is definitely huge. For example, like Arizona, I love Arizona. That's been a great market the last couple of years. So area is very, very, very important. Obviously, you want to be in areas, good job growth, good rent growth, all those kind of metrics that you're looking for. Sometimes an apartment building, an A building versus a B. I tend to kind of like, or B versus even C. I kind of like to be right there in the middle. I like the B class buildings. I'd say for the most part, I think every deal I've invested in was B versus an A or a C. So I think that's important. It's not to say that any of those other classes for those types of buildings aren't lucrative, because that's not the case. But for me personally, I like that B class. I feel like you're right there kind of in the middle. And then maybe too, most of the deals have minimum investment amounts. So, if one deal has a huge minimum investment, I might look at it like, well, and just to give examples for dollar amounts, let's say one deal has a minimum of 100,000, whereas in other deals, maybe you get in for 25 or 50. I'd rather spread that out and get into maybe 2 or 3 or even 4 deals versus just doing one deal. Because if that one deal, for whatever reason, just doesn't work out or doesn't perform very well, I would have kicked myself for going into that one. I'd rather be spread out from a risk standpoint, being a bunch of other deals.
Yeah,
So those are
absolutely. And
kind
that
of some of the
also, I
main.
mean, to that, yeah. And to that point, obviously, I mean, if you're someone that's working with, $300,000, $400,000, yeah, $100,000 being a quarter of your total, available asset pool to do it for. Yeah. If you're dealing with $10 million, sure. But again, I think that always kind of plays to just the amount of diversity that's in that asset class. Is that, yes, I mean, $25,000 is no small sum by any stretch of the means. 25 grams on the ground, you're not going to walk by it and not pick it up. But it's, when you talk about the broader scope of this, yeah, investing in and using, again, the general principles of investing is that diversity is a good thing. All else remaining equal, I would probably be hard pressed for you to find any single competent someone that can legally advise you that would say, yes, you should park all of your money in one asset, be damned anything else. You're going to have one thing and have no diversity. I would say, again, I can't legally advise anyone. Tax advice is not what we do. Check with people that can. But again, I think that's a good thing to illustrate is that, again, the principles of investing and investing safely and wisely can still apply to this. Now, as far as, again, let's talk about, some things that you're looking at. You like to look at things like emerging job markets and different things like that. So talk about some of those things that are kind of thumbs up when you're looking at a deal. At least, again, everyone's mileage may vary. There are different ways to look at these things, but a lot of these things are relatively universal across the board in this is that you don't want to invest in an apartment complex that has, no jobs for 50 miles in any direction and has a population of 100, kind of hard to fill all those apartments if you only no one there to rent them. So what are some things that you're looking at, currently? Let's just, let's be current events type things. What are some things and areas that you like and the reasons you like them and let's go from there.
Yeah, I mean, there's a bunch of different things. Obviously, like you had kind of touched on, you probably don't want to invest in a apartment building that's out in the middle of nowhere and there's nothing around, right? So it's good when there are deals that are, apartment buildings that are nearby, major interstates, big companies. A lot of times you'll hear like an area just got a new Amazon distribution facility, for example, or there's a huge hospital there, or just other big corporate type companies that they probably also do their research on where to strategically locate their buildings. So yeah, being close to highways, obviously anyone that's renting a building, if they're commuting and they're not working from home, they want to have access to that, whether it's for work or other reasons. Companies, big companies nearby, for example, like Arizona, I do a lot of stuff out in Arizona. And they're building a huge resort out there. And that's supposed to bring in, 1,500 to 2,000 jobs. So stuff like that, those kind of like metrics where like, all right, this makes sense. Job growth is great. Rent growth is great. Big companies have either moved their, headquarters out there or already existing in that have a presence there. So those are kind of some of the main things I'm looking at when I'm looking at deals. Does it make sense? Does it check all the boxes?
Sure. And where are some of the resources that people find this? Is this stuff that's typically going to be found in the investor deck? And if it is, how do you trust but verify that? Obviously, I can write anything on a piece of paper and give it to someone. It doesn't make it true. So when you get this, you look through it. Is that kind of information put in the prospectus in the PPM? Is it something you have to look at externally, or are there some things that you always look externally that aren't included in the PPM? So again, for people coming in looking at this new, that's great to understand the metrics of what you can kind of look at to say, okay, this is going to be a viable investment. But how do you find that information? Where is it located, and how do you go about doing your research on that?
That's a good question. Yeah, typically that stuff's going to be located in the investment summary that you're looking through. But again, it's always good to do your own research as well, your due diligence, so to speak. It doesn't hurt to jump online or make some phone calls. I happen to have a friend that I used to work with here in the Chicagoland area that moved out to Arizona. So that's another good resource for me to always, kind of touch base, see where things are trending out there. And I go visit him every couple of years, and I just keep seeing that those areas out there just continue to expand and grow. Those are all good things. So is the information in the investment summary? Yes. For the stuff I'm looking at, it is. It should be. But should you double check some of that? Absolutely. But it still also goes back to, who you're investing with. I have 100%, 110% absolute trust who I'm investing with. So, after you get into a deal, 2 deals, 3 deals, you do trust the source of information. But I would always highly suggest anyone, newer to the space, always, cross-reference, double check, do your due diligence.
When he talks about, that's good from that part, but let's also talk. You brought up again the trust in whom you're investing with. And now, again, correct me if I'm wrong, but you haven't done every single deal with that one gentleman you met that you played baseball with, correct? You've done some deals with other people.
They're pretty much all through that person that raises the capital. That's basically the syndication group. But they've partnered with so many different general partners in those different areas, whether it's Arizona, Georgia, South Carolina, for example, or Colorado.
Mhm.
So yeah, and then some of those deals have gone full cycle where then they roll into another deal. So then you're kind of off on a tangent with a different general partner. So I'd say for the most part, yeah, all those deals look the same in terms of the investment summaries and how they're laid out.
Okay, now I guess let me rephrase the kind of the point of the question is, how do you necessarily go about, being comfortable with the person, like the general partners? What are some of the metrics? Do you look at like, how many other deals that they've done, who they've been involved with? Do you, it's like the mini background check. What are some things that you like to check off your list of saying, okay, haven't met this person before. What are some things that I like to see? Is there a minimum amount of deals? Is it, a voucher from, a certain number of investors? Or what are some things that make you comfortable with that? Because again, if you're investing 25 grand with someone, you want to be relatively comfortable, especially 100 grand, $1 million, all these things, you want to be relatively certain that you're going to make your money back plus a return on it. So what are some kind of, basic metrics that someone walking into this can kind of comfortably say, okay, great. Here's some things to look at, as far as, where to start with being comfortable with these people.
Yeah, usually the investment summaries have some sort of track record, right? So, a history of like, hey, this is kind of when we started doing this, or even you can look at the company's website. It'll tell you when the company was, founded, when they started doing deals, how many deals they've done, how many, assets they have under management, that kind of stuff. But yeah, usually in the investment summary, you'll see a track record of all the deals. You'll see how long they took to go full cycle, what the equity multiple was, the return. And again, that's also kind of plays into the more you network, the more people you meet in the space, whether it's through Facebook, LinkedIn, going to a conference in person, for example, the more people you meet, all these different general partners that I've, come into contact with, I've seen their stuff online. I know they're doing really good things. But at the beginning, I didn't know a lot of these different entities or companies or people. So you just have to continue to meet new people, talk to people, do your research, and kind of gain that trust, because that's really that's an integral component to doing all this. Because if you don't have that trust, you're going to send out that money for that deal, and then you're going to constantly be thinking about it every night before you go to bed. And you really want to have that trust factor. That's super important. So
Yeah.
to answer your question, I don't know. It's not really a 1 + 1 is 2. I think it just over time, you kind of know more and more people, and you have more trust based on networking and doing your research, if that
Yeah.
answers the question.
And I
So
think that's a great point to bring up again, because I always like to, bring a lot of the investments we do down to the masses, because investing in securities, it's a tough thing to understand. There are so many different things in the, marketplace called, stock exchanges that are insanely complicated to understand and make a viable investment strategy besides just throwing a dart at a, newspaper and picking stocks, that these things can be that simple. It is, looking at a 160-page packet of, investment prospectuses and outlays and, all these different things. It can be intimidating, but it boils down to understanding whom you're investing with, what the actual numbers look like. And like you said, networking and everything like that works wonders. One big thing that I've experienced in being involved in the alternative space for as long as I have is that people in real estate, whether it's single family, multifamily, mortgages, they love to talk about it. There's one thing that people invested in real estate are not, and that is quiet. So if you want to go and meet people, and if someone's invested in real estate and you want to ask them questions, typically there's not a secret sauce like there is in the stock market. If you want to ask them, say, hey, what's worked for you? They'll be like, oh, X, Y, and Z. This has been great. I had troubles with this. I've done really well with this. This is what I'm doing. And expand that, going to network with these different places. There's a ton of free resources. I'm going to Jake and Gino. They run the Wheelbarrow Profits podcast, and let's call it just their syndication. I think it cost me like $300 to go to their conference. This is not, networking, especially on the bigger sense. These aren't like $10,000 courses that people are having to take. You can do this stuff for pretty cheap. And then, getting out there, talking to these people that are invested in it, Because another thing is that if some of these people are not acting the best interest or they've had bad experiences, again, people in real estate like to talk, you'll hear about it. You'll understand that. And it's, again, you should always do your due diligence. You shouldn't just take, John or Jane's comment at the bar of saying, hey, this guy was no good, don't invest with him. Do due diligence, but, talk to multiple people. It's not just going to be one person saying something. It's going to be a lot of people. You can kind of get that track record and relatively easy in this space too. But it's a lot more face to face. It's not as much, just going out there and Googling what people are used to. You do have to change directions a little bit. But the nice thing is it's very personable. It's kind of brings it back to that, round table discussion of getting to understand and know whom you're investing with, because these things are not large. You're not investing in a company that has millions of shareholders. They're going to be maybe 30, 40, 50 different people invested into a deal. It's not a whole lot of people, and you can, again, build that trust and comfort on a very micro level with this stuff. Even though they're large investments, it's not a large pool of people that you're dealing with, which is, again, really fun. So
that face, I didn't mean to cut you off. That face to face is huge. Like we had one earlier in the year, just outside Chicago. My friend that I, invest with that does the syndications, and they had a group in from South Carolina that they partnered with on previous deals. In fact, that was the group I did my first ever deal with. So it was cool to actually meet those people in person. And then it's kind of a runoff from there. I met other investors that had all invested in a lot of the same deals that I've invested in for the last 3-4 years. And now I talk to those people I met. Some of those people I talk to every single day. So we're constantly talking about this stuff, whether it's, hey, are you in this deal that, from 2020 in Arizona? Or, hey, did you see that new deal that just came across the desk? And like, are you getting into that one? So you don't want to feel like when you get into this space, you're on an island by yourself. The more people and resources you can have, it's so important because you can always reach out, whether you think it's a dumb question or just to talk about something in general. It's just, I can't stress that enough. The networking, the face to face, the just talking about it all the time. And then I'm constantly learning, like, I've learned a lot of stuff over the years, but some of these people I talk to, I'm like, oh my God, they know way more than I know. So, and that's where that education kind of comes into play, whether you're paying for it, $300. It sounds like a lot of money, but it really isn't. Education's a huge, huge thing. If you can pay to learn and meet people, or just meet people in general, whether it's free or you pay for it, I can't stress that enough. That's extremely important. Just sitting behind your desk and not getting out there, it's only going to take you so far.
Yeah, and again, to kind of keep this on the level of people that are looking to get involved in this stuff, people in real estate are generally friendly. Bar what you see on the HGTV shows and stuff like that with like Selling Sunset. A lot of people that do this are pretty friendly and down to earth. They'll sit down and have a meal with you. They'll have a beer at the bar, and you can ask them all the questions that you want to, and just understand that this stuff is not a huge barrier to entry of this walled garden that you have to scale. People are more than happy to share their experiences because the other thing I really like about this is that everyone pretty much started in the same place with this. Again, no one goes to college and gets a doctorate in commercial multifamily real estate. They started in mortgages, or they started in an alternative investment company that does, everything from real estate to, farmland to, startup companies. Everyone kind of comes, it's a melting pot, kind of like the United States of America. It's everyone kind of comes from somewhere else. If you dig back far enough, no one's really kind of born into this. They all come from different places. So they've all had the same questions. And there's really not too many things as far as a stupid question. Granted, going up to someone and saying, hey, give me your whole life story, and just sitting there and taking notes and not trying to add value probably won't make you too many friends, but, be friendly, be willing to learn and trying to add value to everything, and you'll probably be okay. But again, you talk about always learning. I was interviewing someone else for the podcast, and I can't remember the gentleman's name, but I've been involved in investments for a long time. I've read through a lot of these, and he brought up a red flag that I think was really good. Is that when you're looking at a investor deal sheet, making sure that you look at if they're using a difference in a return on capital or a return of capital to determine what your actual return is, that people that you might want to, flag a little bit, if they're saying it's a return of capital, you might be making progressively smaller returns because your rate of return is based on your underlying capital investment. And if they're knocking that down, then you might be missing out on cash flows. So small things like that are things that you can pick up just by having a conversation. I never would have
Yeah,
thought that small switch could mean the difference of tens of thousands of dollars for an investor if you didn't understand return of or return on. One word can make a huge difference, and you get that just
absolutely. And that's, yep. And that's a good point. I mean, if you're kind of newer to it, that's where having somebody, a resource to reach out to, say, hey, I read through this investment summary. I think I understand it, but is there anything here that maybe I missed, right? Like, I'm sure there's still tons of things that I read through, and maybe I missed some things too, but that's a good point. You really want to know what's going on. And that's, again, back to having resources, having people to talk to. There's nothing wrong with talking to people and asking questions. Like you said, people are friendly in this space. I haven't met a person yet that's not good to talk to or willing to try to help out. There's a lot of cool people. It's just everyone's kind of in it together. Even if there's a competing, I don't know, different deals, or maybe a capital group versus a different capital group, or whatever the case might be. Like, everyone still, you kind of feel like is playing together, and that's good to know. Just reach out, ask many questions as possible. There's really no dumb question. I mean, you gotta ask. If you don't ask, you just don't know.
Yeah, and again, I really enjoy the fact that we keep coming back to the simplicity of it and the human nature aspect of this. This stuff can look intimidating from the outside. You talk about buying buildings that are 10, 15, 20, 50 million dollars, and people are like, oh wow, that's I'm gonna buy some Facebook or Google. That's it makes sense to me. It's much more grassroots. And to your point of understanding these people, and people are generally nice. I've met very few, let's call it, unpleasant people in this space. And who those people that aren't still perennial people in the space, the people that weren't very nice. Again, trying to keep it PC, you can interject any type of adjective you want for those kind of people, but they fall off. The people that are nice and genuine are the people that are going to stick around. So if you talk to someone and they say, hey, I've been doing this for 8 years, and you talk to another person and say, hey, have you ever heard of them? Say, oh yeah, you've been knowing this guy for like 5-7 years. If they've been doing it for a while, again, not to say that you should say 5 years, absolutely doing that, I can trust you, do your due diligence. But for the most part, they're going to be relatively good people that have been doing it for a while. With that said, we've kind of, again, harped on the simplicity of it, understanding that trust factor, understanding what you're reading, networking with people. Again, all these things that seem basic, but are a huge portion of what builds a successful foundation in this. Are there any other types of specifics that maybe we didn't touch on that have helped you specifically? Or you think that people, again, looking at this from the outside saying, hey, I'd like to, try to crack this nut, that might be beneficial to people, that have been useful for you?
I can't think of anything specific. I mean, I think you kind of touched on all of it. Like, before I even got into the space, I used to drive by apartment buildings, and I just thought some big corporation owned them, and there's no way that someone, like myself or you, could even invest in that. And so I think mindset's a big thing, just with anything in life, but especially in the investing space, you got to have the right mindset. And, we're not solving some crazy algorithms here. It's not rocket science. You just gotta, meet people, do your due diligence, and dive into it. And just always remember, this is a long haul. This isn't a sprint. We're not trying to do this and get in and out, in 6 months. You got to be in it for the long haul. So I don't really have anything specific to mention, but just keep plugging away at it. Keep learning as much as you can. And even if you're listening to podcasts, a lot of times at the end of the podcast, there's somebody who maybe was on that podcast that usually gives out their contact info. Well, I've done that tons of times where I'll actually reach out to that person and I'll say, hey, I listened to your podcast. It was fantastic. You gave your contact info. I reached out. I had some questions. And usually those people they respond, and I think that's important. You got to reach out, you got to feel comfortable, and you got to learn as much as you can.
Yeah, absolutely. I think those are kind of great points to bring this in on a landing, and I'll echo that. It's some of these people, especially the larger names that you might see market themselves a lot that do a lot of these things. You reach out to them because maybe it's not them, but someone on their team that's been working for them with them for a long time will probably certainly reach out to you. So don't be intimidated by even the larger names in the space once you start looking at it. Most of these people, again, they're friendly people. They want to make money, just like you do. They're not, and they're not going to continue to make money if they don't, act in someone's best interest and also meet new people that want to invest with them. So, with that said, Brandon, thank you so much for being with us today. I really enjoyed the conversation. I think it's really refreshing to have the different perspective. Again, we talk to a lot of people that invest in the limited partner side that want to immediately make the jump to a GP or manage these things. But I want to show that people, there is absolutely space for people to be successful in the limited partner space, and it is not a huge barrier to entry to do so. Networking, eagerness to learn, and basically understanding that there's no stupid question, I think, are the three big takeaways from today. It's just, get out there, ask, talk, network, read, ask questions, rinse, wash, repeat.
Yep, absolutely. You have to start somewhere. So you're not going to get into 10 deals right out the chute. You got to start somewhere. Like I said, get off the sidelines, get into the game, right?
Yeah.
Do a deal and go from there. So yeah, absolutely. Those are all great points.
Great. All right, Brandon, we'll bring it in for a landing. Is there anything do you have anything going on? You want to put your contact information out there? If not, that's okay. But I always give people the opportunity to plug anything they have going on, or if they want to reach out to people, let them know.
Yeah, absolutely. I'd love to help anyone out that I can, whatever that might mean. So an email, a phone call, I'm usually available. I remember being new to this too, and it was a little nerve wracking, at the beginning, and you just keep learning. So it's good to have resources like I mentioned. So feel free to reach out to me. My cell phone, I'll give you my cell phone. It's 630-696-2716, or you can email me too. It's my full name, Brandon Cotie, BrandonCotie at GOAPMC.com. So if you have any questions, I'd love to try to help out. Feel free to reach out to me.
All right. Thanks, Brandon. Well, again, everyone, thank you for joining with us today on this edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and have a great day.